All right, guys, bang, bang. What's up? We'll wait for a couple people to get in here. But long story short is I'm going to spend the next hour or so trying to talk through whether I think the economic crisis is going to get worse before I think it's going to get better. And in order to be able to do that, let's first start just with where are we? I think is an important place to start. So if you remember, kind of end of February, really, we had one of, if not the best economic situations in the United States that we've ever had. And we saw record low unemployment. We saw stock market highs. Every single thing that was going on just seemed to point to a very strong economy, a very robust economy, and one that, for the most part, didn't seem like it was going to slow down. If you go back, though, there were a number of economic alarm bells that had gone off late last year, everything from inverted yield curves to a high number of corporate CEOs leaving their jobs. And so there was definitely signs that, look, we're in the longest bull market in history. It is likely not to go on forever. But we don't know when that's going to end or what's going to be kind of the accelerant that really kind of turns over the market. And so obviously coronavirus occurs. And even at the end of February, I don't think a lot of people took it very seriously. And it seemed like we were going to keep having this raging economic situation, positive economic situation. If we go now to today, we are basically 8 to 10 weeks since that time period. Most of the government mandated shutdowns in the United States started right in the middle of March. So call it 8 weeks since then. And we've seen 36 million Americans file for unemployment, for some unemployment claims in the last 8 weeks. That puts us into very deep kind of unemployment percentages, in many ways to compare it even worse than the Great Depression. We've seen GDP in Q1 fall 4.8%. That's pretty telling given that only the last 2 to 4 weeks really had pressure from the virus on the economic side. So Q2 should be much worse. And then on top of that, we've seen literally tens of thousands of small businesses around the country mandated to shut down by the government. And so when I look at the current situation, I tend to look at three key factors. One is, what is the economic data saying? Two, what is the anecdotal information coming from the operators on the ground? And then three, what is the stock market or the public market saying, kind of the speculators or the prediction market that the stock market provides. And so I'll walk through those three things here and kind of give you an understanding of how I'm analyzing both the market and also various asset classes. Before I forget, I keep getting told, make sure that you hit the little like button on this video so more people can watch it. Make sure you subscribe to the channel. And if you leave comments here in the live chat, I'll do my best to answer some of the questions after I get talking for a little bit. So going back to those three things, first, let's start with the economic data. I already mentioned 36 plus million Americans have filed for first-time unemployment benefits in the last 8 weeks. Really, really bad situation. We have tens of thousands of businesses that are mandated shut down by the U.S. government or the state governments, and some of those states are starting to come back online. Other states are actually extending the lockdowns now, so not a good situation there. If you look at GDP, down 4.8% in Q1, likely to be worse in Q2. And so what ultimately happens is you have to remember that the economic data we get, it is a lagging indicator for the reality on the ground, right? What I mean by that is you only know about the unemployment numbers that were filed last week. So at worst or at best, you have a 1 week lag in the actual unemployment claims. On top of that, you don't get a very accurate representation of kind of true unemployment. So things like freelancers, gig workers, self-employed, they're not eligible to file for unemployment claims. When you then look at things like the people who want to file but can't for certain reasons. If you look at things like workers who actually have had their hours cut, or maybe they're working the same hours, but their pay has been cut. All of these things blend into the situation around employment in the United States is much, much worse than 36 million Americans having filed for unemployment. So back in March, around March, I think 22nd, give or take a couple of days, I wrote a piece that basically said, look, based on the very early data on the unemployment claims, I believe we are headed to Great Depression levels of unemployment by the end of Q3. I literally was laughed at when I wrote this, and I provided a bunch of math as to how I thought that the travel and hospitality industries were going to contribute to this, but also other areas would get hit as well. Well, in hindsight, I wasn't aggressive enough, right? My mistake was actually not being more aggressive in the understanding of the market. And so what we've seen is we've literally seen from going from about 5.4 million Americans that were unemployed at the end of February, or a 3.5% unemployment rate, we've now seen that jump all the way into the double digits. We've seen over 36 million Americans file first-time unemployment claims. So that is a really, really dire situation. At just 36 million, that's basically 1 in 5 people in the labor force in the United States are without a job right now. Now, if you look at GDP, if only the last, call it 2 to 4 weeks, really was affected by the coronavirus, that was not a lot of time out of a 90-day period in Q1. And so my guess is that the Q2 GDP numbers are going to be horrific. And if coronavirus has taught us anything, it's that we actually underestimate how bad the damage can be. And so if you think about Q2 GDP numbers, well, all of April, we were on shutdown. So literally just the entire economy ground to a halt. In most of May, we're going to be in an economic shutdown in most of the major areas for economic activity in the United States. And so it would not surprise me to see us print a negative 20% GDP number in Q2. Negative 20% GDP is off the charts, completely unfathomable at the beginning of this year. But I'm becoming more and more convinced that we're going to see negative 20% GDP in Q2 for this year, which is absolutely devastating on any way you cut that data. And on top of all of this, we then get into a conversation of, well, how many businesses are going to come out the other side of it? So first bucket of what is the economic data telling us? Economic data is telling us it's really, really bad economic situation. I actually think it's a lagging indicator, and it's underestimating how bad the reality on the ground is, right? So it's already bad enough to look at the data, but the situation on the ground is even worse than what that data is telling us. So if we go to bucket 2 and we look at, okay, well, if all of this economic data is actually really bad, why is the stock market, right, kind of the public market or the prediction market provided by stocks, actually rallying? Why do we see stocks going up, but economic data getting worse? And the reality is that the stock market is not a representation of the economy. The stock market is actually a representation of central bank actions, especially during a time of crisis. And so if you go back to 2008, 2009, when the economic crisis happened, all of a sudden the government stepped in and said, hey, we're going to bring rates down in our emergency cuts. We're also going to start to print money. And for the most part, it worked, right? And what I say it worked is it worked for what they were optimizing for. They were optimizing for the least amount of economic damage and the fastest road to recovery. They were not optimizing for solving the economic problems. They were not optimizing for actually helping make sure that the structure of the U.S. economy was sustainable. It was simply, how do you short circuit a recessionary period and get back to recovery? And so what we saw there was it worked if that's what you were optimizing for. Well, fast forward back to 2020, and all of a sudden we get to this recessionary period, and what do you see? Rate cuts immediately to zero. You then see printing. So far, we've printed a couple $1 trillion. There's a plan that's working its way through the government for another $3 trillion. We'll see if it gets passed or not. But what ends up happening is, if this next plan or proposal gets passed, the Federal Reserve balance sheet will have doubled in the first half of this year. Think about that for a second. We were at $4 trillion, give or take, on the Federal Reserve's balance sheet. We're now already over $6 trillion. So we've already had a 50% increase. If they pass another proposal, we are likely to get a doubling of the Federal Reserve's balance sheet in a single 6-month period. Absolutely crazy. But that's what the stock market is responding to. The stock market investors see, oh, wait a second, the government is stepping in. They've got lending programs. They've got all sorts of relief and aid packages, and they're going to print trillions of dollars. We know that that will devalue the currency. Other assets should stabilize and eventually rise in price. So something like stocks, I should be buying stocks during that time period. And I'll get to why I actually think that's a bad strategy in a little bit. But economic data looks bad, stock market recovering, not recovering because of the economic data, recovering though because they see the government stepping in and they see that the government is going to use the 2008 playbook of monetary policy or a quantitative easing to try to stabilize and drive recovery in markets and short circuit a recessionary period. So that's why you see stocks going up. Then you get the actual reality on the ground, or the third bucket. And that third bucket is the most important one. So it's the anecdotal stories and data points that you see on the ground from actual operators. What that tells you is that will give you the purest signal onto what is actually happening in the US economy. And so a couple that I've seen recently are things like there's a coffee shop chain. I forget the name of it. They've been in business for over 30 years. They have 50 locations. And today they announced that they're shutting down, right? Completely shutting down. After 33 years of business, a 50 chain coffee shop is going to go ahead and completely cease operations and shut down their business. That's not a mom and pop shop, right? Everyone's worried about the small business on the street corner that's got one location, a family runs it, and they're hoping they can get by. We're talking about a 50 location chain coffee shop shutting down. Neiman Marcus, JCPenney, et cetera, all filing for bankruptcy, right? They cannot make this work. Then all of a sudden you start to see all of the pressures when it comes to commercial real estate. You start to see small businesses, right, that are actually firing their employees and closing up shop. So here in New York City, a bunch of restaurants have started to come out and say, look, it was a great ride. We really appreciate all your guys' support, but we're not coming back. And so remember, we are only 8 weeks in to this economic crisis based on the government mandated shutdown. And so this is the most important data point to me, mainly because I believe that it is foreshadowing a much, much dire situation moving forward. And what I mean by that is if already 8 weeks in, we are seeing 50 location coffee shops shut down forever, if we are seeing small businesses shut down forever, if we're seeing large retail chains like the JCPenney's, the Neiman Marcus's that were already under pressure and now kind of got the knockout blow, file for bankruptcy, this is going to get way, way worse. And what I estimate is actually happening is there's a bunch of business owners right now that are saying they're holding on for dear life. They got some PPP money from the government. They got maybe some revenue by trying to get to online ordering or something like that. And they've been able to just kind of coast and barely make some of the payments they need to make, barely pay some employees. What ends up happening, though, is as we get to the end of May and into June, I think that's when we're going to start to see really, really large number of businesses come out and say, look, I lasted for 60, 70, 80 days. That 90-day mark is when you're going to see a bunch of them just give up, right? And they're going to say, I can't make it out of this thing. And I don't think that the U.S. economy is going to be wide open, by kind of the middle of June, not in terms of policy of being open, but actually the velocity of money rolling and actually getting economic activity back. And so that on the ground anecdotal data tells me that we are actually going to have a much dire situation ahead of us, and it's going to get worse before it gets better. And I'll give you a couple of ancillary impacts there. So first of all, if all of a sudden, let's say 15 to 20%, right? I wrote about a month ago, I think 20% of small businesses are not coming back from this, right? And these are, small businesses make up about 50% of jobs in the United States. These are usually kind of one, maybe 2 or 3 locations, usually kind of family run, held for a long period of time. They have no kind of private equity ownership or venture capital ownership. They're what you think of as a Main Street business or a small business. My guess is that those businesses, 20% of them, not coming back across all industries. Doesn't matter if it's travel, hospitality, or it's something else. And so if all of a sudden you get to a world where 20% of those guys don't come back, if they are responsible for 50% of jobs, overgeneralization, right? Easy back of the napkin math. That means that 10% of total jobs in the United States just got eliminated in already 8 weeks or 90 days, right? So if it ends up being true that 20% of small businesses don't come out of this, 10% of all jobs in the United States just evaporated, right? Really, really bad. We don't know that yet until we start to see more and more of these businesses bow out and say, look, I just can't make it. And so I think that is one key piece of this. The second piece of it is right now, everyone is holding on to the hope and dream that when the state governors say we're opening up our state, there will be an explosion of economic activity, right? All the pent up economic activity. People want to go back to restaurants. They want to go into movie theaters. They want to travel. They want to go to the store. They want to do all this stuff. Warning. Be very, very cautious when we see the initial data when they reopen these states, right? It's what I previously described as a dead cat bounce in the economic data. So what do I mean by that? In China, in Wuhan, China, we saw in weeks 5 to 9 after they reopened the economy, there was an explosion in economic data and it peaked. And everyone said, look, we very quickly within 9 weeks reached the pre-pandemic levels of our economic activity. Well, if you then go to weeks 11, 12, 13, et cetera, now all of a sudden there's a decrease in that economic activity. And so where it's basically stabilized is they've lost about 20% of the economic activity compared to pre-pandemic levels. So what you get is you get a big drop, right, during the government mandated shutdown. You get this what looks like a V-shaped recovery because you get an explosion out of the gate of all these people who rush back to stores, restaurants, et cetera. But then after it stabilizes, you actually have a net loss of economic activity. You're at 20%. So imagine if you go back to February and I said to you, we are going to lose 20% of economic activity in the United States. You would think that that was absolutely horrific, right? That would be destabilizing. That would have all of these repercussions. Well, we're going to get to that point most likely. It's just going to be hyper volatile in terms of a huge drawdown, a huge recovery, and then you get that net loss. And so I think that what's going to happen here is as small businesses start to go out of business, as we see more pressure on large corporations, as we see even more pressure on commercial real estate, right? And states start to reopen, there's going to be a lot of noise. But be warned that that dead cat bounce is very likely. We've seen it in other regions that have opened up. And simply it's because consumer behavior has changed, right? I continue to ask people, how many of you are willing to go sit right now in a super crowded restaurant? I'm not talking about, hey, you go sit at a table with two friends and there's somebody sitting at the table next to you. That to me isn't crowded. I'm talking about walking into a New York City bar where you used to stand shoulder to shoulder. I just don't see that happening, right? How many of you are willing to get on flights right now for non-essential travel, right? If it isn't work related, how many people want to go on vacation right now, right? How many people are actually going out and spending money if they were able to on goods or services, right? There's a lot of people sitting at home who are sitting there thinking, I don't need all of the things that I previously thought I needed. I don't actually spend nearly the money on the goods and services that I thought I was doing. And so I believe that there will be a net loss in economic activity coming out of this, which will be very detrimental. Now, where does this mean for the stock market, right? I continue to say that when we see earnings for Q2, it is going to be a reality check to Wall Street. Now, what does that mean? The reality check to Wall Street right now is everyone is praying for, one, the central bank actions to take hold and to drive this recovery in the economy. And two is they're praying that that pent-up demand comes raging back, right? If you look at something like the American box office, right? I've talked about it before. In the third week of March of 2019, the US box office for movie theaters did over $200 million in revenue. The third week in March of 2020, they did $5,000 as an industry, 99% loss of revenue, right? Everyone is sitting there saying, I think it's coming back. I think it's coming back. There's going to be this massive recovery. There will be a reality check when all of a sudden there isn't a massive recovery in economic activity. And therefore, I think that we will see another pretty large leg down in the public stock market. I own no public stocks. I am not a stock picker. I am not a stock investor. I just think when you look at an economy and all of the moving parts that make up the complexity of it, understanding where some of these markets are going are really important. And so it would not surprise me one bit to see a massive leg down in the stock market. This would be very similar to what we saw in the Great Depression, right? There was a drawdown, there was a relief rally, and then there was a second leg down. We've seen that in other areas. And so that would not surprise me here. And I think that catalyst for it is going to be the shock to many investors that there's not going to be this V-shaped recovery in economic data like they think that there's going to be. And ultimately, it comes down to this. We are seeing the virus accelerate a lot of trends that were already existent, or already kind of moving in the right direction. And also the virus exposed a lot of shams in the US economy. And so simple shams are things like corporate debt loads, right? Or the higher education model. If you look at retail, physical retail spaces, right, versus online ordering. If you look at things like our supply chains, all of these things are now being exposed by this virus. And so when I had Chamath come on the podcast, Chamath Palihapitiya from Social Capital, brought up a great point that previously the U.S. economy was driven through a search for efficiency. We wanted the lowest cost, most efficient processes and supply chains and businesses. But what we gave up in that search for efficiency was a focus on resiliency. And because humans are humans and we have recency bias, this will change the mindset or the psychology of an entire generation of people, both from investing and building companies. I think you're going to see an over rotation back, and people are going to seek to build resilient systems and resilient companies. Well, that means that there will be a lack of efficiency or a loss of efficiency as they go to get that resiliency. So you will see things come back onshore from overseas. You will see consumer behavior change, but I just don't see it coming back nearly like I think many people do. And so if you walk through the various asset classes, kind of how do I think this will play out? I think one, the stock market, there's a massive, massive dislocation between reality on the ground and the stock market numbers now. This isn't rocket science. I'm not the only one saying this. If you guys hear that beeping, that is Polina cooking in the kitchen. She says hello to everybody. But basically, if you think of that economic data, and where the stock market is, there's got to be either a recovery in economic data to meet the expectations of Wall Street, or there will be a repricing or price discovery of the stocks to meet the economic data. I think the latter is much more likely than the former. If you look at something like real estate, we have not yet seen massive correction in real estate yet. I believe that is coming. But again, if you are sitting there and only 8 weeks ago, you were able to sell your property or your building at a certain cost, 8 weeks isn't enough time to really think, hey, things have changed, right? And again, you're holding on to the belief that we're going back to the world that we lived in. And so I think that there's going to be a lot of kind of slow, deals being done there. But over time, we will see there a market correction in real estate prices, both commercial and residential, and that will take time. But when it happens, it's kind of a slowly, but then all at once. And so once you start to see 1, 2, 3 large players in a market crack and start to lower prices, or deals actually get minted at lower prices, then you'll see an acceleration. You'll see every deal get done at that repriced kind of market. And so I think that's coming. Oil, I tend to think that all of the kind of chaos in the oil market, all the geopolitical aspects, that's going to continue to play out. Yes, they are promising to cut production, but I do believe that it will have some positive impact. With that said, I do not think that the economy is going to be opened up fast enough to drive a drastic recovery in demand for oil. We're going to have the same problem that we for the June futures contracts, that physically settled futures contracts that we had for the May ones. A lot of the oil reservoirs and storage is filled up. And so what ends up happening is there's just no ability to store the oil. Nobody wants to hold the contracts. I wouldn't be surprised if we see negative oil futures contracts again for those June settlement dates. I previously tweeted and said, I don't know if it's going to go negative 100, right? I think last time we went to like negative 50, give or take. But I do think that it's possible. And just the possibility of seeing a negative $100 futures contract for oil being printed is just, again, unfathomable 8 weeks ago. Now you see a path to it. While it might not be probable, it is possible, which I think is pretty telling. And then if you look at things like gold, Bitcoin, other inflation type assets, I think that it is very obvious that the central banks and the U.S. government has decided that they're going to print their way out of this. And I find it very difficult to believe that history will not repeat itself in the sense of, one, as they print more and more money, you are devaluing the currency. It's absolutely incredibly painful to the bottom 50% of citizens, but it enriches the top 50%. We can get into why that is. But on top of that, you are going to see people fear inflation. So this is a key point. inflation doesn't actually have to occur for inflation hedge assets to be successful and to have high returns on a kind of basis during the crisis. You simply have to have the fear of inflation. What do I mean by that? If you go back to 2008, gold went down 30% in the summer of 2008. When it dropped, it was during that liquidity crisis. Everyone wanted to sell every asset they could. They were looking for dollars. Every asset sells off and the dollar strengthens. Gold was not safe during that point. It drew down 30%. It then, from 2008 to kind of 2011, went up over 200% and ended up hitting an all-time high. But what's very interesting about that, while the government was printing money, we never actually got high levels of inflation, right? Because the deflationary environment soaked up that liquidity. But the reason why gold performed so well during that time period was because there was a fear of inflation. The inflation never actually happened, but the fear was enough to actually push the price of gold up. I believe we will see the same thing here. I expect both gold, Bitcoin, and other inflation hedge assets to do very, very well. As many people know, I think Bitcoin's going to be the best performer coming out of this crisis, but it's simply the fear of inflation will drive that activity. It's not actually inflation having to occur. So that's it for right now. I have no clue how long I've been, 25 minutes or so. Nice little monologue there. I'm going to go back and try to answer as many of these questions as I can. I'll stay on for about 30 minutes or so. So just fire off your questions and I'll do my best. The stock market is manipulated big time. Yeah, look, I think that this is a no-brainer at this point. The stock market is manipulated through central bank actions. The part to me that is not concerning is central banks. That is their job, right? Is to use interest rates and quantitative easing in order to manage an economy. They're technically not supposed to be managing the stock market. They're supposed to be managing the economy. They're not supposed to be managing a currency or a stock market. Well, one, we know that they definitely are paying attention to the stock market. They continue to make announcements. The Fed made a bunch of announcements. I think it was Friday, right as the stock market closed. Like they are definitely watching the stock market and paying attention to that stuff, whether they want to admit it or not. The second piece of this is you, by definition, you are manipulating asset prices when you print money, right? You are devaluing a currency and stabilizing and increasing stock or all asset prices, but stock market also. And so by definition, you are manipulating the market. You may say that it is okay you are doing that, but you are manipulating the market. What's more concerning to me is the constant parade of administration and kind of government officials that go on television and try to instill confidence in people. So you see everyone from Larry Kudlow to Jerome Powell to the Treasury Secretary, et cetera. They continue to go on television and say things like the U.S. economy is strong, the U.S. economy will recover. Larry Kudlow literally at the beginning of the crisis was telling people to buy stocks, buy the dip, and then kind of backtracked on those comments later. For the first time this past week, we saw Jerome Powell and the Federal Reserve start to talk about, wait a second, this is going to be bad, right? Before it was all about instill confidence. Now all of a sudden we're starting to get a talk track that is much more sobering. Jerome Powell is actually on 60 Minutes tonight. So it'll be interesting to see what he says. But my guess is that now that they have switched their talking points, right? If you read what they're saying right now and go back 2 weeks to what they were saying, it is a 180-degree difference. Before it was coronavirus is real. We have an economic slowdown. There will be a V-shaped recovery. We will be back. Now, all of a sudden, they're having a much more sobering conversation, and the talking points are, hey, this is going to get bad. Yes, the U.S. economy is going to suffer. It's much worse than we thought. All of those types of talking points. That type of manipulation, I think, is very hurtful to investors. But obviously, it's the government. They can do what they want. Let's see here. I'm so old. I remember when being a millionaire meant you were rich. Yes. I also saw on Twitter today, somebody said, at this rate, we're all going to be billionaires, right? And basically they were referencing, if you think of, Zimbabwe, I have a $1 trillion, piece of paper that I carry around in my wallet. And really it's just the idea that as they print more and more money, the currency becomes devalued, right? That currency, as it gets devalued, you need more of it to buy the same goods, right? I continue to point people to look at what's happening in Lebanon right now. I think Lebanon is a great example of what can happen if you are not careful in these situations. So for those that are unaware, Lebanon, previously there was a number of government protests that were occurring kind of pre-pandemic. The pandemic occurred. They put a shelter in place type order. Everyone went inside, including the protesters. During that time, there's been incredible volatility and debasement of the currency. The central bank has done a fairly poor job in controlling that currency. The currency's seen a massive drop against the US dollar. All of a sudden, they start to open up their economy. And what do the protesters say? The protesters say, hey, we were pissed off beforehand. Now we're even more mad because now not only are you actually mismanaging the currency and the economy, but now there's capital controls in place. So if I'm a Lebanese citizen, I go to the bank. They've put tons of restrictions on withdrawals. They also won't let me withdraw in any currency other than the Lebanese pound. And then on top of all of that, food prices are soaring because there's been a bunch of shutdown on the pandemic side. And so all of a sudden, you get a population of people that go to sleep every night. And when they wake up, they have to question, can I afford food, right? Has my wealth been devalued away, right? Imagine if you were sitting there with the equivalent of 10,000 US dollars in your bank account and you woke up tomorrow and that $10,000 that used to buy you 1 acre of land now only buys you half an acre of land or a quarter of an acre of land, right? Your savings, even though the account says the same number, it's actually being devalued away. And so that's one of the things happening there. Massive social unrest. I think that we are going to see coming out of this crisis, incredible social unrest, whether it is physically demonstrated through protests and other things in the streets, or it is done through digital means like Twitter and others. And coming out of the 08-09 crisis, a lot of people were really upset with the U.S. government or with the big banks, right? It was all about the banks caused the crisis. They're bad people. They're greedy. They hurt the little guy. The kind of Occupy Wall Street, Zuccotti Park, all that kind of stuff. That was the sentiment coming out of 08-09. Coming out of this, I have no doubt that people are going to point and say, my government is the reason that this all happened, right? They're going to look at all of the data that is now surfacing from the virus, right? Look, I believe that the virus is very real. It is very dangerous. And I tweeted today, it is possible to think that the virus is dangerous. It is possible to think that we shouldn't overwhelm the healthcare system. It is possible to think that our reaction has decimated the US economy. And it is possible to believe that the data that is being reported is inaccurate. And it is possible to believe that we should reopen our economy in a safe and intelligent way and do it quickly. So it's possible to believe all of those things. Most people that are having this conversation, though, they want to have a very binary conversation. Pick the healthcare system or pick the economy, right? They don't want to have the nuanced conversation. What you have to remember is the world's complex. So what does that end up meaning? Here's a great stat for you. The numbers that I saw recently are Los Angeles County, right? One of the most populous counties in America has 13 deaths that are attributed to coronavirus. Now, I'm not here to say, is that good or bad, right? I don't know. I'm not an epidemiologist. I'm not a healthcare professional. That's just the data that I read. What I do know is that as people see data like that, every single person in Los Angeles County is going to start to say, wait a second, 13 people died? I can't believe that they decimated our economy over 13 deaths. Now, part of the fallacy of that argument is that we don't know what the impact of social distancing was, right? What would it have been if we didn't do social distancing, if we didn't do the shelter at home, if we didn't shut down businesses, all of these different things. But what ends up happening is because of the recency bias, people feel the economic impact. There's only so many families or individuals that knew those 13 people who died, right? But 100% of people saw the economic carnage. And so what you get is you're going to get this blaming of the government. And then really it's going to be the state governments, I think, where people are going to say, hey, my state leaders or my local leaders are idiots. They blew up our economy. It wasn't as bad on the healthcare side as they told us it was going to be. And therefore they made mistakes, right? Again, unfair because it's hard to tell what would have happened if we didn't take these steps. But I think that that's a huge part of this that's going to end up happening. And we're just not ready really to do that yet. Let's see here. People are staying home even without lockdown orders. People are scared. Institutions aren't communicating clear, truthful info so people can assess true risks. So I don't know about the truthful part to this. I definitely agree that people are staying home even without lockdown orders. We saw this before the lockdown even started, right? Which people were basically told, hey, social distancing, work from home if possible, all that kind of stuff. And so I think people are changing their behavior. Obviously, putting the shelter in order places really kind of accelerated that for everybody. I do agree that institutions and or politicians and leaders are being really, really bad at communicating, right? And there's two buckets to this for me. So one is a lot of the communication I've seen from leaders all the way from the national level down to the local level is there's a politicization of every single thing, right? The number of deaths, whether something's open or not, who gets funding, all this kind of stuff ends up being politicized. And so that just in general, I think a large portion of the population is tired of hearing that stuff. And they want the economy turned back on and they want people's lives saved, right? They don't want that politics stuff. So I think that's kind of strike one. Strike two is every single leader that I've seen, their actions don't match their words. So I'll give you two examples. One is they go up and they do these press conferences and they don't have masks on. Right. Today, I saw a photo literally of Andrew Cuomo in New York. He was getting a coronavirus test. They were literally putting it in his nose. And the person administering the test had gloves on, had the surgical gown. They had a mask on themselves. And then they had the healthcare shield. And they were giving the test to the governor of New York State. And the governor of New York State had no personal protective equipment on. And so what an image like that tells people is you're telling me to wear a mask, but you don't have a mask on. Again, doesn't mean that masks aren't helpful, right? I actually think that masks are helpful. But what it tells them is you think that you are better than us. You think that you are higher than us. You think that you are above the rules. You're doing things, or you're telling us to do things that you're not willing to do yourself. So I think that's kind of step one where people are really looking at their leaders and saying, why are you asking us to do things that you yourself aren't even doing? The second thing then is when it comes to finances. So I've said from the very beginning that if I was the governor of a state, the first thing that I think that they should do is they should give up their salary for as long as they keep small businesses closed in their state. Why? It's not because of any reason other than you immediately say to small business owners, I'm in this with you, right? As long as you suffer, I'm going to suffer. And as your leader, I'm never going to ask you to do something that I'm unwilling to do myself. But that's not what we're seeing. Instead, we literally are seeing our politicians continue to take paychecks while our small business owners and employees of a lot of these businesses are actually being told you are not legally allowed to operate your business. You cannot actually go to work. And so I think that that's a huge mistake there in terms of the leadership. I don't know why Paulina is, she basically has like a fire going on over here. Will house prices dump at Christmas? I don't know if house prices are going to dump at any specific time, but I definitely think that on the real estate side, we're going to see three things happen. I'll start with the commercial side and then go to residential. So on the commercial side, I think there's three arguments right now. One is that people are going to completely get rid of their offices and go 100% remote. One is people are going to keep the amount of space that they currently have and or downsize. So they're going to take into account some of these coronavirus type things and basically change the way that they use space. And then three is somebody like Eric Schmidt from Google who believes that actually people are going to rent more space in the commercial side so that they can allow for social distancing and other things. I don't think the third option is very viable. I think that one of the first two options is much more viable. And so we've already seen a number of businesses start to say, hey, look, we don't need space. We're going to go 100% remote. We were forced to do this. It actually went pretty well. We're going to continue to do this. We're going to save a bunch of money. Another option is people are either going to change the layouts of their office or they're just going to need less space because some of their employees will work from home while some still go into an office. And so I think that you'll see kind of that price pressure happen as these economies start to reopen, people start going back to work. You'll see people start breaking leases, not re-upping for leases. And so that commercial pressure will probably happen over the next 12 to 18 months. When you go to the residential side, well, one is if your business starts to go and is completely remote, now I'm not physically tied to any one place. I can live wherever I want. So take a place like New York City. Why am I paying, a higher rate of rent if I no longer have to go to the office for my business? I can go move to any other place in the world, really, and just work remotely. Now it starts to create all kinds of pressure on residential real estate as well. And so I think I saw recently that vacancies are at an all-time high, or at least a local high in New York City. Also, new rentals. So kind of the rate at which places are being rented out is also very high, or is very low, right? So basically, there's a lot of pain going on there. And so I think that what you'll see is in the residential market outside of the major metros, you will start to see some areas get decimated. People just want to move out of high cost areas. San Francisco, for example, I just don't see those housing prices stay high like they have been, but other places will benefit, right? So think of your states with the little to no state income tax, places that have nice weather, all of that kind of stuff. If all of a sudden I can choose where I want to live and I'm not tied to it based on an occupation, I do believe that you'll start to see some changes there, both positive and negative. But I don't think it's going to happen for Christmas. I think it'll happen some other time. All right. So a lot of people are asking about the Fed and the Fed chair. Here's what I would love to say is I think that it's an impossible job, right? I don't think that this part is really ever talked about enough, but I think that being the Fed chairman is an impossible job, especially in times like this, because you'll never get it right. Right. There's too many complex components of the U.S. economy for you to get it right. Really, what you basically are trying to do is you're trying to make as least mistakes as possible. So I think that they are optimizing. Again, you got to go back to what are they optimizing for? They are there to manage an economy. They're not there to manage a currency. They're not there to manage a stock market. They're there to manage an economy. And so part of managing an economy is making sure that there's as least damage as possible on the downside. But what that does is it short circuits the recessions or the depressions, and it doesn't change the structural issues, right? Right now, if you go to the federal relief programs, for example, one of the things that just cracks me up is part of the loan process has been that there are companies about to go out of business, right? So whether we think that it's fair or not, companies that have been bad capital allocators are about to go out of business. And all of a sudden, we are going to hand bad capital allocators taxpayer money, right? Now, again, that's a huge overgeneralization, but I do think that as in a true market cycle where a downturn would wipe out some percentage of businesses that aren't healthy, aren't sustainable, aren't good businesses, and then allow new entrants into markets, right? New competition and kind of rebuilding of an economy in an upcycle in a market. When you go ahead and you print a bunch of money and you hand it to everybody, what you basically do is you short circuit that. You don't allow for the clearing out of the bad businesses, and therefore you end up having some issues over a long period of time. So it's a hard job, but I do think that it's going to be pretty ridiculous. In terms of the impact here. The other thing that I will say is it is quite comical also to me that in the latest, I think it's the House proposal, the $3 trillion stimulus package that has been proposed, we have seen things like there's $3 trillion in the program. $1 trillion of it is for state and local governments. Right. So literally, they're going to print $1 trillion and they're going to hand it to the worst capital allocators in the world. Governments. And they're going to do that. And there's not a lot of checks and balances in place there. So $1 trillion gets printed and handed to all these governments. And the way it gets handed out is not very well understood yet. I have no doubt that there's going to be financial incentives tied to COVID impact, which then again has a circular impact on, well, if all of a sudden I'm a state governor and the amount of money I get from the federal government to bail me out is dependent on how many COVID deaths or infections I have, then I'm financially incentivized to inflate that number as high as possible. And so I think that you're going to see a lot of that. It would not surprise me. One thing that I do think is going to happen in the future that I haven't talked about this yet, I do believe that there will be some sort of corruption investigation at the state level. I don't know what state it is, but there will be some sort of corruption investigation based on COVID data reporting. Right. And so whether that is hospitals inflating numbers so that they can get money, whether that is cities or states or there's going to be some sort of audit at some point, and there will definitely be nefarious or bad activity going on there. And that doesn't necessarily mean that they're all overinflating. There actually could be undercounting intentionally, right, for some financial reasons as well. And so I do think that that's likely to occur as well. Let's see here. Yes, the rich get richer and the poor get poorer. So this is my main concern with all of this, right? And I think it's really important to talk about is whenever you print money, you basically are widening the wealth inequality gap, right? And the way that works is the bottom 50% of Americans, give or take, they live paycheck to paycheck and they have no investments in real assets, right? So everyone's heard the stats. They can't afford a $400 emergency payment. 45% of Americans don't own a stock, whether it's in a brokerage account or any sort of retirement account, all these kind of things. And so the IMF wrote a paper in the late 90s, basically said inflation is the number one cause of wealth inequality or one of the largest drivers. And that's really for two reasons. One is it devalues the money. So if you are sitting there and you only have $400 or $500 in your bank account, every year your savings, you don't have a lot, is being devalued away. So that $400 or $500 can buy less and less year after year. You don't own any real assets. On top of that is many of the people in the bottom half of the country do not have inflation adjusted wage contracts. So what that basically means is, let's say you have a white collar job, you get paid, $70,000 a year. Every year your salary goes up 2.5%, simply as an inflation or as a hedge to inflation, and therefore you never see the impacts on your pay, or you're actually getting paid more and more every year to account for that. Well, that person that gets paid, $10, $12 an hour, they're getting paid $10 an hour year after year after year. They think they're making the same amount of money, but actually the purchasing power that they're receiving from their employer is going down because they're not getting that adjustment for inflation year after year. And so what that leads to is this massive wealth inequality gap, and the bottom 50% actually get poorer over time. On the flip side, what does inflation do? It drives asset prices, right? If you ever look at a chart, what is the stock market? It's just literally up and to the right at a 45-degree angle over a long period of time, right? Pretty much every other asset class, same thing. Why? Because of inflation, right? In some cases, yes, the businesses are getting more valuable, but also you're seeing a devaluation of the currency that it's priced in, right? If you take something, for example, like the US dollar and say, what is the S&P 500 denominated in dollars? It's up and to the right at a 45-degree angle. If you then take that same S&P 500, but you say, what is it denominated in Bitcoin? It's actually down at a 45-degree angle, down and to the right. Now, why is that? Well, because one of those assets is an inflationary asset. The other is a deflationary asset. So it's really important to always understand that part of the asset prices that you're seeing or the movement you're seeing is driven by the currency in which it's priced, right? And obviously the stock market with dollars. And so I think that what happens here is rich people basically know the game, right? I always say there's kind of 4 rules to getting rich, right? One is to have multiple streams of income. Second rule is to spend less than you make. Third is to get out of inflationary assets into deflationary assets. And fourth is to stay patient and be disciplined, right? It's pretty simple. Those are the 4 rules to get rich. Rich people know them. And so the number 3 rule is really, really important. They get out of currency and they get into real assets. They own real estate, they own stocks, right? They own commodities, et cetera. And so as that currency gets devalued, they see their asset prices rise. They actually are getting rich during this, right? If you think about it, the top 55% of Americans actually own stocks. They're super excited when they see that money printer start, right? That's why stocks are rallying. They're buying because they see, hey, there's going to be a road to recovery. And so I think that's where you see kind of the rich get richer and the poor get poorer during these times. That shouldn't be a surprise to many people. Let's see. I live in Berlin, Germany, where things officially reopened this week. However, things just seem a lot less active than before. Restaurants look almost empty. There's not just that many people outside. Yeah. So I think this is a good example, right? Everything's going to be anecdotal for the next couple of weeks until we get hard data. But I do believe that even though places are open, right? Here in the United States, for example, they're telling restaurants that they can open with 25 to 50% of capacity in many places. So, I read an article that people are literally putting mannequins in the restaurants and dressing them up so it doesn't seem like creepy, which I don't know if it's more creepy that the mannequins are there or that the tables would be empty. But with that said, if you think of a restaurant, for example, you're now saying, okay, you're not shut down. So the federal relief is likely to end for you. And we'll let you open up, but you can only open up at 25 to 50% of capacity. Most restaurants, the economics don't work, right? They need to be open up at 100% capacity. They can't do it at 50% capacity. And so actually what may happen is by having a kind of a slow rollout or kind of the staged reopening of economies and capacity constraints and things like that, you actually may kill more businesses by not simply just reopening to everybody. Obviously, there's health concerns with it, so there's a balance. But it doesn't surprise me that restaurants look almost empty, and there's just not that many people outside. I think we'll have the same thing here in the U.S. Hopefully that doesn't happen, but I think that's where we're doing. Israel relatively open due to good response, but demand for services and products is low. Negative 25% unemployment. Yeah, I mean, look, we're going to see this kind of entire story all around the world, right? I don't think that it matters, if you're in the West, if you're somewhere in the Middle East, if you're Europe, in Asia. It's just human psychology, right? Is you just spent weeks and weeks and weeks sitting at home and having your government tell you, it's bad. Don't go outside. You'll die if you go outside, right? All of this kind of stuff. And now all of a sudden they're like, okay, go back outside. it's like, what? Imagine if you were a kid, right? And your parents said, hey, don't go in that room. If you go in there, you might die, right? And they kept telling you that. And then one day they said, okay, you can go in the room. Well, you might go open the door. You might kind of peek inside, right? You might tiptoe inside, but you're not just going to open the door, go running inside and like hope nothing bad happens, right? Same thing here. And so will that be it, kind of the human psychology forever? I don't think so. I do think that there at some point we will get back to some feeling of normalcy. It still won't kind of show for many years of full return on the economic data side, but there's a psychological scar here in terms of the way that people are going to interact with others and kind of the places they go. Additionally, I think that there's a psychological scar on investors and operators in that now you're going to start to hear people talking about not is my business recession proof, but is it pandemic proof? You're going to start having investors talk about, well, how long can you go with $0 in revenue? All of that kind of stuff. I think we'll play into that. And then lastly, another key piece of this is Polina's making chicken wings, so she's super excited over here, squirting her barbecue sauce. But on top of that, I think that another aspect that's going to be really interesting to watch is just how many people are willing to change the way that they earn money. Right. If you think about this, I said this previously, that if you want kind of true freedom, financial freedom, and freedom in your life, one of the best things you can do right now is learn how to make a living with only an internet connection. Right. So forget going in somewhere, forget any physical products, forget all of this stuff. All of that stuff just got taken away. But this digital economy, I think you're going to see a lot of people start to say, wait, one of the ways I need to pandemic proof my salary, my livelihood, is I need to figure out how to make money with only an internet connection. And so that wouldn't be surprising to see that kind of accelerated over time as well. While I'm looking at these questions, remember, hit the like button on the video so more people can see this. Make sure you're subscribed to the channel as well. I keep getting people texting me, telling me to tell you that to everybody. Let's see here. So opening up, look, there's no magic pill to how we open up the economies, but I do think that it's important in terms of the way it's done. I do think that there is a path where you can say our hospitals have not been overwhelmed, but we're still worried about it potentially happening if we do this incorrectly. We believe that masks, hand washing, and social distancing are important, and therefore we are going to completely open up 100% of our economy, but we are going to be very fanatical about the masks and the social distancing and all of these types of things. My guess is that you'll get some economic activity coming back, some relief. It won't be nearly what we need, but I definitely think that that is possible. Somebody said, I work as a security at a hospital and there are way more COVID cases happening because they get $39,000 if they have a respirator. I wish I owned a hospital. I don't know, kind of what the validity of that is or isn't. But I definitely know that there's some financial incentives for having a COVID patient. Do I think that the government will transition to a gold standard? I think that there is nearly 0% chance that the government is going to transition to a gold standard. I think that what we are seeing is the playbook that every great dynasty has implemented in order to ultimately shoot themselves in the foot and fall. I do not see that on the short-term horizon for the United States. But this is what every single great dynasty has done. They have devalued their currency to the point of economic weakness, and then they have seen somebody else come in either through invasion or just the threat of invasion and ultimately become a military superior country and ultimately then take over as a global superpower and implement their national currency as the global reserve currency. I tend to think that that's what we're doing here. It's sad, it's scary, but I think that's kind of what's playing out. In terms of Bitcoin, I've talked a lot about this idea that I do think that there's a paradigm shift when it comes to global reserve currencies and military might. If you think about in the analog world, the way that you get to have the global reserve currency is you use bombs, bullets, and soldiers. You go and you invade somewhere, you kill people, you show that you have the most military might, and therefore you are the global superpower. Just the threat of you going and doing that to other countries, they succumb to you. They allow you to install your currency as the global reserve currency. And that's how it's worked for thousands of years. The only difference is now war is going to be fought in cyberspace in many cases. And so in cyber, whereas in the analog world, having the offense makes you the strongest military, actually in cyber, it's having the greatest defense will make you the strongest military. And so if you think about Bitcoin, it has the strongest computer network in the world, and therefore it is most resilient to attack. And therefore, I think that there's a possibility that Bitcoin will, over a number of years, it's not going to happen in the short term, ultimately rise to become the global reserve currency because it will have the strongest military in cyber terms, right? From a defense standpoint, and it'll have been able to do that without shooting a single bullet, drop a bomb, or use any soldiers, which would be pretty interesting. I'm going to take 2 more questions here, and then I'm going to go eat some dinner. So let's see here. Yeah, so somebody said I started a new Etsy store and it's going very well. First of all, congratulations. Second of all, I think that this is going to be a really important conversation. So first, what I would tell people is you are responsible for your own life, right? It is your responsibility to make a living, take care of your family, and ultimately be happy. I think there's a lot of people looking around right now saying, well, the government's not doing this for me, or the government's not doing that, or I want to blame this person or blame that person or whatever. But ultimately, you're responsible for your own life. And so what I mean by that is you have to educate yourself with the skills necessary to make a living. And so if you go back to this idea of if you want true freedom, go figure out how to make a living using an internet connection exclusively. Right? If you can use an internet connection and make money, then you have true freedom. And you can live where you want. You can do what you want. You can make your own hours. You can do all this stuff. The problem is many people don't have that skill set. And so I think that there's going to be an explosion of people interested in this. They're going to go figure out how to get the skills to build digital businesses, everything from content production to selling goods online, to building SaaS products or writing software, all that kind of stuff. But I do believe that while people have been sitting at home for the last 8 weeks, give or take, there's a lot of people who are contemplating, do I actually want to do what I've been doing, right? Or do I want to go pursue a different career? And so I think that that's the type of stuff that people are going through right now. And they're going to spend a lot of time getting those digital skills necessary in order to go ahead and make a living with just an internet connection only. Okay, so there's 2 questions here that I'm going to kind of combine them. So how concerned are you about inflation? You see people buying inflation hedge assets, but you see other investors talking about deflation. And do you think the stock market will crash this year? In some weird world, I'm going to say yes to all 3 of these. And so what do I mean by that? I am concerned about inflation over a long period of time. I think that there is going to be a deflationary period in the short to medium term. And I believe that the stock market will have another correction this year. Now, how does all of this happen? So first of all, we had the massive drop in the stock market. We then had the relief rally. For anybody who pays attention to kind of the various retracement lines and things like that, I think it went right back to like it was 68 or 82% retracement, whatever the hell it is. People way smarter than me, help me with all this stuff. But basically, there's a retracement right to that, likely that it'll turn over and fall again. And that's mainly because the economic data on the ground is a complete separation from the stock market, right? There's just a dislocation between the 2 of them. So I do think that there's going to be correction. Now, part of what that relief rally has been the printing of money. And like I said, the stock market is a representation of the central bank actions, not the economy. And so over a long period of time, it's literally just math. You cannot print money and not get inflation at some point. You can't not devalue a currency. But over a long period of time, the U.S. government's done a pretty good job of preventing that from getting into a hyperinflation situation like Venezuela, Zimbabwe, name your favorite dictator's playground. So with that said, I do worry about the inflation over a longer period of time, but I do think that the deflationary environment we are in right now will continue for some period of time, short to medium term. And so in a world where somebody like a Paul Tudor Jones is positioning himself to mitigate the effects of inflation, but Drunken Miller and others are positioning themselves to take advantage of the deflationary environment, I think that they're actually both right. They're just right on different time horizons. And part of that is the Federal Reserve understands, and even the Treasury, et cetera, They understand that the dollar continues to strengthen. Asset prices have sold off. The only way you're going to eventually get asset prices to sustainably recover is you're going to have to systematically weaken the dollar. And the way you do that is you print money, right? And so I don't think that the printing is done. Again, like I said, Federal Reserve balance sheet, $4 trillion at the beginning of this year, give or take. It's over $6 trillion now, 50% increase. I think that they're going to go ahead and I jokingly said this, but I'm becoming more convinced that $3 trillion spending plan that was recently proposed and passed in the House. I know that the Republicans are saying that they don't want it, all this kind of stuff. But I do think that we are going to see trillions more printed, and we will get a doubling of the Federal Reserve balance sheet this year. And so ultimately, you end up getting inflation long term, but the deflationary environment will eat up a lot of that in the short term. We live in a crazy, crazy, crazy world. I really want to just leave everyone with this message of, like, I cannot hammer it home enough. The number one thing that I think people should be doing right now is learning. And what I mean by that is, if you are interested in the economy or financial markets, it doesn't matter your age, you are getting a crash course in crisis, in human psychology around investing, in Federal Reserve actions, in repo markets, in quantitative easing, monetary policy, all these different things. Educate yourself and pay attention. Make sure you are paying attention to what is going on. You are getting a free class in what happens in these scenarios. They only come around so often. Really, the last one in any material size was back in 2008, 2009. So you literally had to wait 10 to 12 years to actually get this class. Pay attention. Make sure you're taking the time to educate yourself. Make sure you're trying to talk to as many smart people as you can. Write down what you're actually thinking about, right? On whether it's a daily or weekly basis. How are you feeling? Where do you think asset prices are going? How do you actually evaluate kind of the markets themselves, the central bank actions, all that kind of stuff? I think is really, really important because that crash course is, it only comes around, once a decade or so. With that said, you were also responsible for your life. And so taking personal accountability or responsibility is incredibly important. If you're able to do that, you will have a significant advantage both in life and in these situations. Understand that people are going to be highly, highly emotional. They're going to be highly, highly psychologically weak. And so you will see things like massive panics when prices fall. You'll see massive FOMO when prices rise and recoveries, like we recently saw in the stock market. That is going to permeate into other asset classes as well, whether it is, oils, physically settled future contracts, whether it's things like gold and Bitcoin, or even real estate. And so understanding the human psychology around investing is really important. Make sure you're controlling your psychology, your emotions. Walk away from the screen is super important to doing all of this. And just generally try to understand that all of this will pass, right? We will get back to some level of normalcy at some point in the future. There might be some pain, there might be some volatility between now and then, but ultimately we will get back there. And so before I leave you with that, Polina, they want you to come and say hello for 2 seconds. She's going to make an appearance.
My hair's crazy.
There is Chef Polina. Her hair is starting to look like mine. That's why I have a hat on. So we'll leave you guys with that. Please like the video so more people can see this. Make sure you're subscribed to the channel so that you get notifications when all of the videos come out. I appreciate all the questions. I appreciate all you guys watching, and I will do this again in the future. See you guys later.